Hi, everyone, and welcome to another Taking Stock episode for the week ending the 12th of April. My name is Jason Yin, and joining me today is my esteemed colleague, Daniel Ortisi. Great to have you on board, Dan.
Yeah, good to be back, Jace. A couple of weeks off for me from taking stock, so happy to be back for our members.
Fantastic. Good to have you on board. Well, we've got a lot of information prepared for this episode, but before we get into the nuts and bolts, an important reminder to our viewers that the information we provide today is of a general nature and should not be taken as personal advice. Remember that shares are volatile and past performance should not be relied upon as a guide for future performance. Well, Dan, it was a bit of a bumpy ride in the US market this week as higher than expected readings of US consumer price index poured cold water over the logic for near-term interest rate cuts. Core CPI was up 3.8% year on year in March versus the market's expectation of 3.7%. Now, the hotter than expected inflation print puts to odds of a June rate cut. What do you think about this?
Yeah, Jace, well, without inflation showing clear signs of cooling sustainably, this does make the Fed's objective to ease inflation back to its 2% target band quite hard to reach, doesn't it, in the near term? So, on the whole, the Federal Reserve has misread the current landscape, or so it seems, by still thinking as recently as last month that three cuts were likely this year.
That's right. And if we were to look at the interest rate expectations, the market is still forecasting US interest rate cuts even after the latest inflation print. Given the pressure from high oil prices, a strong US labor market, and overemphasized levels of productivity, it is increasingly likely that the base scenario for the US rates is to hold at current levels.
That's right, Jason. The problem is not just that inflation remains sticky, it's that it could be re-accelerating from the last print that we saw. So,
Mm,
as such, the Fed might be forced to capitulate from their hawkish view, and this could spell bad news for equity investors. Of course, we do know that Tim and Matt from the Lincoln Managed Funds still hold their contrarian view of the market, that the conditions are still way too frothy, particularly in the large caps in the tech space in the US. If the
mm.
prospects of interest rate cuts were removed, along with a decrease in the rate of company earnings, investors, in our view, Jace, could definitely be in for a rude awakening.
Yeah, that is a little bit of a concern. And it's also the reason why we should maintain a degree of caution when it comes to portfolio positioning, Dan. Well, while we're on the topic of interest rates, we really can't neglect the big elephant in the room, which is the soaring price of gold. After trading in a fairly steady range for months, the bullion has started spiking in early March, and it has risen around 14% since then and left a string of daily record in its wake. So, Danny, are you going to share your thoughts on some of the preferred gold exposures that we have in the sector?
Yeah, definitely, Jason. A lot of our members have been asking questions about gold, particularly across our Lincoln Live sessions. So, of course, tune in if you do have those active questions. But really, the pace of the gold rally has been surprising to all of us, Jason, really reflects perhaps the skepticism that institutional investors have on the outlook for inflation and interest rates. Certainly, it's counterintuitive to perhaps what we were talking about at the start of the year, a rate cutting scenario. So, we currently have four gold miners within our star stock universe, which actually reflects an overweight position within the Star Growth Stock strategy relative to the index. So we have been bullish on the outlook for the precious metal. Just to quickly touch on these companies, Capricorn Metals, it is a low-cost operation based locally in the country in Western Australia, and it's reached nameplate production in recent years. It actually has a new development project that it's heading towards for growth, though probably positioned for a sensible option for investors seeking production growth within the industry. Perseus is a more established name. It also has higher jurisdictional risk, with its mine mainly in West Africa and a lower growth outlook as its key mines now in what we call the cashed harvest phase. So, with over $900 million Australian on the balance sheet, I think further deals are likely for this company, which would be kind of upside for the
Mm.
stock in our view. Alkane is a small cap, which in our view is definitely unloved by the market, Chase. But if the company can reach its 100,000 ounce per annum production target, this is another one we think is very overlooked. And finally, perhaps one that's a bit more topical, given its recent updates, is Gold Road. And we do think that its interest or 20% ownership of De Grey, which is a significant development project in Australia, this could cause some serious corporate action in the near term. And that's why we're happy to remain there as a star stock for now, despite perhaps a recent step up at costs at its current mining operation.
Wow, that's a great summary on the gold sector, Danny. And it seems like there's still gold in them hills. Over onto energy. That's been another pretty interesting topic as oil has broken out of its recent trading range and surging to the highest level since October last year. However, the forward price curve for the price of Brent oil suggests that prices are in backwardation. Now, what this means is that future prices are lower than current prices. This is the case because the emergence of supply risks over the recent months due to increasing unrest in the Middle East. Oil traders are largely shrugging off these concerns and instead focusing their attention to weaker economic prospects, especially in Europe, and also poor demand for oil. Of course, these current assumptions could change if the extreme scenario results in an escalation in the Middle East conflict, which could effectively pull out a fifth of the world's oil supply from the total supply band. And this could effectively cause a bit of issues, especially in regards to trade routes in this region.
Yeah, very good points, Jace. And taking all that knowledge and bringing it back to perhaps how we're thinking about our star stock and our strategy, certainly
Mm.
our position in companies such as Woodside Energy and also Karoon Energy remain favorable to those trends. Then also that's kind of exacerbated by their rising levels of production as well. Certainly the rebound in the Henry Hub gas price and also stable oil prices expected in the short term will benefit these companies in our view. And you've started to see a bit of flow into these stocks. It is
Mm.
important for clients to note, though, that Woodside's earnings projection for FY24 do appear subdued. That's really predominantly due to a decrease in commodity prices from recent peaks, as we know, during the 2021-2022 reporting season. Nevertheless, the company's production capacity does continue to be robust, and its quality certainly is there, Jace.
Hmm.
But moving on to the corporate calendar. So for the week ahead, we don't have any upcoming ex-dividends in our star income stocks or financial reports, but do keep an eye out for the quarterly reports from our mining companies as they will start to be released over the following week.
And for Under the Microscope this week, we take a closer look at a major deal announced for personal protection equipment and glove manufacturer Ansell. The former Star stock did pique our interest given the company hasn't really made any large acquisitions since 2013. Are you able to provide us with some of the details of the acquisition, Danny?
Yeah, well, Ansell did agree to purchase the personal protective equipment or PPE arm of large US industrial manufacturer Kimberly-Clark for around US 640 million. So a decent price tag given the company's current market cap. On initial glance, it certainly does look like a highly complementary deal, given the business operates in new markets for Ansell, such as electronics, pharmaceutical research, and specialist protective equipment. Now, on the face of it, it does appear to be a relatively boring business and boring industry, but it does require perhaps a bit of a further look because its financial returns shouldn't be underestimated. The operating margin of the acquired business are twice of that of Ansell at around 24%. And since the
Hmm.
business is mainly a distributor, it does appear to be capital light with only around $1 million in capital expenditures in the calendar year for 2023. Hence, the conversion of earnings to cash would be really significant for this business, Jace.
Now, those are pretty interesting points, Dan, and it also pays to really look under the hood when you're comparing a lot of these companies, especially when acquisitions do take place. Now, in terms of Kimberly-Clark, they are more of a specialized business compared to Ansell, which is why their margins are higher. If we were to compare the purchase price multiples, from what we understand, it is below Ansell's current trading valuation and suggests the capital raise may be a little bit dilutive in the short term. However, ROE should be revised upwards in the near future, and this could bring it closer to our star stock criteria. The market also appears pretty supportive of the deal, Dan, considering that it did resume trading well above the offer price.
That's right, Jason. That last point is really interesting, considering when we had Aura acquire Saverglass, it was trading at a
Hmm.
significant discount, and also a similar phenomenon with Treasury Wine. So it does seem well supported
Yeah.
by the market. Of course, just to summarize, it does appear on face value to be an attractive deal and quite complementary to the existing Ansell business. And perhaps given that margin uplift, it will improve the overall quality of the group. So we'll continue to monitor the stock, which have suffered since the overall PPE and glove industry was oversupplied post the COVID-19 boom in demand for these products.
And with the commencement of Stock Doctors Masterclass in Sydney next week, what a better way to cover off on the importance of portfolio management? So the question for this week is How does Stock Doctor help investors manage their investment strategy and also keep track of their investment ideas?
Yeah, a great one, I think, this week, Jason. There are, of course, a myriad of tools within Stock Doctor to help members invest with confidence, but an overlooked tool is perhaps Stock Doctor's My Journal.
Hmm.
A journal is a fantastic way to store the reasons and rationale behind your investment decisions, so you can learn and improve from your past experiences. In addition, it allows you to hone your investment strategy and keep abreast of all important company updates. Of course, it's also easier to remember things when you write them down rather than perhaps relying only on reading them, such as our commentary or perhaps an article.
Hmm.
As you discover companies of interest, add them to your watch list and include a journal note about why you're watching them. For example, you might have read an article on a company which sparked your interest. You can also link this article within the journey entry as well.
Great point. And accessing the tool is also pretty easy as well. Simply navigate to the tools and select My Journal. Here, you can create a new entry and also write down your notes on any particular company, like you said, Danny. You can also tag your notes to any company or companies or a portfolio, or even use a custom tag. An example of a custom tag might be the group of, say, lithium stocks, for example. On the left-hand side of the journal lies the journal filter, and this allows you to quickly find your notes based on your tags, dates, or other keywords. You can also filter by company name and sort your entries in date order. Keep your journal up to date with any investments or changes to your watch lists so that you can keep track of why you bought them or why you've sold an investment.
Thanks, Jace. Certainly helps us remember even why we make our investment decisions as well, keeping a really
Yep.
defined journal and notes. Of course, thanks to everyone for tuning into today's episode. I hope everyone enjoyed it. It was quite information packed today, so hopefully we did a good job of explaining everything. Of course, members who want to get to know more about our masterclass event in Sydney on Tuesday next week should get in contact with our office or reach out to your client and service manager as soon as possible. It is also a promising event and an exciting event as we'll be discussing a range of topics, including how to develop and apply tactical risk mitigating strategies, mastering the art of stock selection with our proven Lincoln methodology, how to sidestep common investment pitfalls and discover high quality opportunities, and also gain a mastery of Stock Doctor's suite of tools to amplify your investment portfolio. So, Jace, we both enjoyed presenting this week, and once again, we'd like to wish you a happy, healthy, and prosperous week ahead. See you in the next episode.
Thanks, everyone.